Nigeria spent $2.86 billion on external debt servicing in the first 8 months of 2025, new figures from Central Bank of Nigeria have shown. This accounted for 69.1% of total payment of $4.14 billion during the period under review. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kikelomo Okere. Comparative, the country spent $3.06 billion on debt in the same period of 2024, representing 7.07% of total payment of $4.33 billion. The data reveals that although Nigeria reduced its absolute debt servicing bill by $198 million, which is 6.49% year-on-year, debt repayment still dominates its external obligation essentials. For every $10 that left Nigeria between January and August 2025, nearly $7 went towards service debt. Monthly data shows that significant fluctuation reflecting the structure of Nigerian loan obligation. In January 2025, the country paid $540.67 million on debt, slightly lower than $560.52 million in January 2024. By February, payment dropped further to $276.73 million before surging to $632.32 million in March, more than double the $276.17 million recorded in March 2024. April remained at high with $557.7 million compared to $215.20 million a year earlier, while the May recorded a sharp fall to $230.92 million, down by $623.45 million from $854.37 million in May 2024. June climbed modestly to $143.39 million, almost triple the $50.82 million recorded a year earlier. July slipped again to $179.95 million, representing a two-third, declining compared with $542.5 million of July 2024. By August, payments recovered $302.3 million, slightly higher than the $279.9 million recorded a year earlier. The month-on-month changes in 2025 underline the erratic nature of Nigerian debt service obligation. From January to February, payment fell by 49%, then spiked by 129% in March before dropping to 12% in April. May saw a steep decline of 59% relative to April. June fell further by 38%, before mild rebound in July and August. The dominance of debt servicing in Nigeria international payment is striking. In 2025, 69.1% of all foreign outflow in the first 8 months were used to service debt. In the same period of 2024, the same share was even higher at 70.7%. This indicates that debt servicing obligation consistently consume at least 7 out of $10 Nigerian spends on international payments. This trend raises important concern. First, it places pressure on the country's foreign reserve, especially in the months of heavy outflow, such as March 2025, when $632.36 million went into debt servicing. Secondly, it reduces Nigerian ability to allocate scarce foreign exchange to essential import and capital goods that could support domestic production. Thirdly, it exposes fiscal vulnerability because debt obligations are non-discretional, meaning the government cannot defer or avoid them without severe consequences. As Nigerians spend less on foreign debt servicing, it is observed that the country's external reserve has surpassed $42 billion mark, the highest in over 6 years. According to the data from the Central Bank of Nigeria, the country's external reserve has been on the upward swing since the 14th of July 2025. This is despite the volatility of crude oil markets, with price at below $70 per barrel against the 2025 budget benchmark of $75 per barrel. Crude oil has over the decade been Nigeria's biggest foreign exchange earner, contributing about 90%. Analysts have attributed the rise in Nigerian external reserve to an increase in oil due to a much improved output from what it used to be. Nigerian banks are losing ground in digital payment race, with revenue from electronic business channel declining 3.7% in the first half of 2025, highlighting fintech rising dominance and the lingering problem of service downturn. Analysis of the 7 listed banks half-year earnings shows a mixed picture. Some lenders like FCMB Group, Zenith Bank, Guaranty Trust Bank Holding Company, and United Bank for Africa reported declines, while First Holdco, Stanbic IBTC Holding PLC, and Sterling Financial Holding Company recorded growth in e-business income. The bank collectively reported 223.8 billion naira in the first half of 2025, compared to 232.4 billion naira in the same period of 2024. Analysts attributed this uneven performance to a combination of prolonged network disruption, regulatory pressure, and competition from fintech players. Data gathered shows that FCMB Group, GTCO, Zenith Bank, and UBA declined the most by 30%, 12%, 11.8%, and 5.2% respectively. The dip in the e-business earning raises a question about how prepared banks are to compete in rapidly digitizing economy. E-business has historically been a strong line for banks, often helping to cushion pressure from interest income. A sustained decline could squeeze profitability further, especially in a high-cost operating environment. The future of the payment in Nigeria is being contested. Banks still dominate in the terms of transaction value, but fintech are rapidly outpacing them in transaction volume and customers' stickiness. However, banks like Fesco with 25.1%, Stanbic IBTC with 4.65%, and Sterling Holdco with 2.78% benefited from the Central Bank of Nigeria new withdrawal charges. The CBN says the changes were part of the broadening reform to align transaction costs with operational reality, according to a circular signed by John Onoja, Acting Director of Financial Policy and Regulation, in the third quarter of 2024 and the first quarter of 2025. Many Nigerian banks, including GT and Wema Bank, undertook significant core banking software upgrades to modernize their operations and enhance customers' experiences. Commercial banks deposits with Central Bank of Nigeria through the standing deposit facility climbed to a record of 5.5 trillion naira following the repayment of open market operation bills. OMO refers to the buying and selling of government securities in the open market as a tool used to regulate liquidity, control inflation, stabilize interest rates, and maintain overall monetary stability. It is operated by Central Bank of Nigeria. The CBN repaid 731.13 billion naira to investors on Tuesday, pushing bank deposits with the regulators to an all-time high of 5.5 trillion naira, according to data. The surge followed an earlier increase on Monday when the SDF reached 5.38 trillion naira, boosted by excess liquidity from the Federation Account Allocation Committee disbursement and OMO repayment. In September 2025 alone, the CBN conducted OMO repayment worth 1.2 trillion naira. This included 731.13 billion naira on September 30, 254.9 billion naira on September 23, and 204.9 billion naira on September 16. In the OMO bills secondary market on Tuesday, the overall average yield across the call fell by 44 basis points to 21.00%, down from 21.44% the previous day. According to the FSDH research, average yield across short-term, mid-term, and long-term maturities declined by 6 basis points, 80 basis points, and 48 basis points, respectively. The January 6, 2026 OMO bill saw strong investors' demand, with yield dropping by 180 basis points. Despite the rise in deposits, banks' opening balance dropped to 2.297 trillion naira on Tuesday, representing a 12.19% decline compared to 2.338 trillion naira recorded on Monday. Nigeria broad money supply surged to an all-time high of 119.5 trillion naira in August 2025, reflecting the CBN's tight monetary policy stance aimed at curbing inflation and stabilizing the economy. The CBN data further shows that money supply increased by 11.5% year-on-year, reaching 119.52 trillion naira in August 2025, compared to 107.19 trillion naira in August 2024. On a monthly basis, it grew by 1.7%, that is 117.49 trillion naira in June 2025, though the data from July was not provided. Currency in circulation recorded a significant decline of 18.84%, falling to 4.92 trillion naira in August 2025 from 4.14 trillion naira in August 2024. On a month-on-month basis, it declined marginally by 1.6% from 5.00 trillion naira in June 2025. According to the latest data from CBN, credits to the private sector also contracted, dropping to 73.83 trillion naira in August 2025, a decline of 1.2% compared to 74.73 trillion naira in August 2024. On a monthly basis, private sector credit fell by 3% from 76.14 trillion naira in June 2025. Similarly, credit to the government by bank fell sharply, plummeting by 25.75% year-on-year to 23.13 trillion naira in August 2025 from 31.15 trillion naira in the same period of 2024. On a month-on-month basis, lending credits to government declined by 2.48% from 23.72 trillion naira recorded in June 2025. Commenting on this development, Alius Uche Odu, a member of the Monetary Policy Committee, noted in his personal statement on July 2025 that the monetary base continued to reflect the CBN's tightening stance with a moderation in currency in circulation. He added that capital market activities suggested improved transmission of monetary policy, while investors' appetite for the Nigerian Treasury bill remained firm. Also, in a statement at July 2025 MPC meeting, Lydia Shehu G. Fia, another committee member, observed that monetary aggregate rose with broad money increasing by 43.65% year to date in June 2025, largely to the growth in the net foreign assets. She explained that this factor had minimal impact on inflationary pressure when compared with growth in net domestic assets, which plays a more direct role in driving inflation. A closed pension fund administrator, CPFA, are raising their investment in foreign securities at the backdrop of sustained fluctuation in exchange rate. The CPFAs increased their investment in foreign market instruments by 12.4% month on month to 94.1 billion naira in August 2025 from 83.7 billion naira in July 2025. The report of the National Pension Commission (PENCOM) on pension fund industry portfolio for the period ended August 31, 2025 also indicates that the CPFA's investment in foreign equities increased by 2.2% to 277.4 billion naira in August from 271.3 billion naira recorded in July. It will be recalled that PENCOM recently released a guideline for pension fund administrators, PFAs, allowing them to invest part of the pension fund in foreign currency dominated instruments. This was initially reserved by CPFAs. A closed PFA only manages retirement saving accounts (RSA) for its employees or employees of its parent company if it is a subsidiary. The CPFAs that invest in foreign securities pay their employees in foreign currency. Meanwhile, further analysis of the report that shows that PFA's investment in the federal government of Nigeria securities went up by 1.3% to 15.8 trillion naira in August from 15.6 trillion naira recorded in July. Further breakdown of the investment in the FGN security shows that investment in FGN bond went up by 3.4% to 15.1 trillion naira from 14.6 trillion naira. Investment in treasury bill increased by 2.3% to 610.3 billion from 596.5 billion naira. All right, let's take a quick short break now. We will be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points, where we extract the Nigerian economy and the government policies. Nigerian private sector registered its strongest pace of job creation in almost 2 years as the third quarter closed. This was disclosed in the latest Stanbic IBTC Purchasing Managers Index. According to the PMI, the strong rate of job creation was buoyed by sustained growth in the output and new orders, rising businesses' confidence, and driven by easing inflationary pressure, resulted in firms expanding their workforce to meet growing demand. It was indicated that firms' purchase cost increased at the lowest pace in 5.5 years. The monthly report disclosed that the country's private sector remained comfortable inside growth territory as the third quarter of the year came to an end. The headline PMI posted above 50.0, no change mark for the 10th month running in September, to signal a sustained improvement in the health of the Nigerian private sector, although falling to 53.4 from 54.2 points in August. The PMI again pointed to a solid strengthening of business condition. New business increased markedly in September amid improvement in customers' demand and in the launch of new products. In line with the headline index, however, the rate of growth is to 3 months low. The rise in new order fed through a sharp expansion of business activities with an increase seen across each of the 4 broad sectors covered by the report. Higher output requirements encourage firms to expand their operating capacity in September, with both employment and purchasing activities rising. Staffing level increased modestly but at the sharpest pace since October 2023. Meanwhile, the rate of growth in input buying remains sharp and fed through an accumulative inventories. The PMI over the third quarter 2025 and crude oil producing in the period suggests the oil and non-oil sector may grow by 14.3% year-on-year and 4.4% year-on-year respectively, translating into overall GDP growth of 4.5% year-on-year in the third quarter. Alright, this is where we call it a wrap on Business Points today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.